Good morning. Welcome back. I hope everyone's doing well in terms of their health and all that, and everyone's safe and sound and all that kind of stuff. Today's topic for economics will be fiscal and monetary policy. Basically, this lesson has a big, it's really big right now in the news because it's affecting everyone in this country in the terms of like what they're going to do to try to help and improve the economy of this country in terms of giving you checks, providing unemployment insurance. The whole goal is to keep the economy going before and trying to prevent it from falling into some kind of depression. It is a very, very uncharted situation what's going on to see the economy, get attacked from three fronts: from the demand aspects, supply, and fiscal monetary markets. There's two types of government policies that the United States government will do, as well as state governments, in terms of keeping the economy going. One is fiscal policy, which is government policy to influence employment levels, stability, and prices. And monetary policy deals with changes in the money supply. The fiscal policy tool that we're seeing that's most common is government spending, and basically that's the United States, the president and the Congress of the United States trying to affect the economy directly by increasing the demands for goods and services. What we're seeing today is the government is going to send checks to 93% of people in this country will receive a check within the next few weeks in the range of $1,200 and $500 per child up to the age of 18. The idea is, and the goal of this is for people to use that money and to spend it at the grocery stores, buying takeout food, buying items such as television, and not to save it as much, but to spend it because they want people to keep the economy going. Because 70% of our economy is based on consumer spending, which is C in the gross domestic product formula, and that is very key for us to remember that. So in the next couple of weeks, your parents may receive a check from the IRS in their bank account or in the mail where they're going to be asked to spend that money. You can save it, but they ideally would like you to spend it. And that is the most common way the government uses fiscal policy as a way to kind of keep people going and keep people spending their money. The second one is taxes. Is sometimes the government, and the last time they did this was about 3 years ago when they changed the tax code, is when they lower taxes for people. The most common tax changes are when they lower taxes in order to get people to spend that extra money they normally would have to pay in taxes, or they would get that money taken away from their checks. So fiscal policy, once again, is the government trying to influence spending by giving you the opportunity to use that money to improve the economy. Because when you spend money at the restaurant, you're providing that restaurant an opportunity to hire more workers, to give more hours to that person. The restaurant worker will use that money to go out and spend at another store. And you see it multiplies. And that's the goal of fiscal policy. The second, so there's two types you should be aware of is expansionary. That's the most common one. And we're seeing that right now in the United States where they want to keep government spending. The government is spending more money by giving money to 93% of Americans in the form of checks, but also they're using that money. They're also making other programs like not allowing student loans to be paid for 60 days, or for example, giving loans to businesses so they can keep their workers, keep paying the workers while there's no work, as a way to keep those people getting money in their pockets and spending. Because if nothing is done by the government, the economy will tank further, and it will be a catastrophic effect for everybody in this country. Contractionary policy is when the economy is very good and the government is trying to slow down inflation, so they might increase taxes, which is very, very rarely done. Because for many people, raising taxes, politically speaking, for anyone who's president or the Congress, is not a good idea. It will make them lose when the election time comes around. They will lose, and that creates that's a road they don't want to go through. Most common times is when they cut spending for social programs, military spending. The idea is they're trying to lower inflation. It hasn't really happened that much in the last 10 years or so. But again, as I mentioned, what we're going in right now is unprecedented, and you're going to see a huge amount of spending in the government. And then the second one is monetary policy, which is basically the Federal Reserve. The Federal Reserve is the organization that basically manages the money supply in the United States. Also, how it affects you is number one, when you want to buy a house or when you want to get a car loan and get a loan for a house, the Fed kind of sets the interest rates and what you should pay. So right now the interest rates are very low. You could get a house for 3.3% if you have good credit, whereas in the 1980s, buying a house would be 10% interest for the loan. So the Fed is there for that too. And then also, whenever you get paid, if you ever notice the bottom of the check, there's always a routing number on checks. They're the ones who process checks throughout the country. So, for example, if you have a bank account at First Midwest Bank and your job pays you with a check from Chase, they're the ones that are responsible for transferring the money from Chase to First Midwest Bank to your bank account by using those routing numbers, and they make sure the check's legit and so forth and so on. So the Federal Reserve has a couple policies. Basically, it's the easy money policy. It's what they charge banks to borrow money. So banks will go to the Fed and say, "Hey, I need some money," and they'll borrow. They'll let the banks borrow the money. Commercial banks such as First Midwest, Chase, Citibank, at a low rate. At this point, it's a low rate, and that's how they determine interest rates. And the idea is that if it's easy to borrow money, people are going to spend that money and lower unemployment by hiring people, especially businesses. When the government wants to slow down inflation, they do tight money where it gets a little more expensive to borrow money. And many banks, for banks to borrow money, so it becomes much more expensive, and loans are harder to get because of that issue. So that's kind of what we want to understand about this whole idea. The easy money, once again, is what does the Fed do to expand the money supply? Well, they buy securities from banks. They lower the discount rate. How much banks will need to pay to borrow money. The reserve requirements right now, all of this, lower the discount rate, the reserve requirement, and have been applied to prevent this economy from going down because of this coronavirus. But the reserve requirement is that every bank has to have a certain amount of funds in their bank, certain amount of cash on hand, to make sure that the banks don't go broke. In this case here, there's a big crisis, so the Federal Reserve is taking these steps that have never been done before to try to slow down the economy, to try to slow down the damage from the coronavirus in the economy. Tight money policies, when they're trying to limit the money supply, so they'll raise the discount rate and the reserve requirement. This is what mostly happens when the economy is doing well. To try to slow down inflation, they'll higher the interest rate, in other words, the discount rate, to try to make sure that the inflation doesn't get out of hand. So that's today's lesson on fiscal policy and monetary policy. What I would like you to do is to focus on the fiscal policy aspects, because that is the type of policy that affects us in this country the most in terms of payments, of taxes, and so forth and so on. So please make sure that you finish the assignments today on Google Classroom. The chapters should be posted, as well as the Google Doc. Complete the Google Doc and submit it. I hope this helps you understand a little bit more about fiscal and monetary policy, and I hope you guys are all in good health. Also, one last reminder, please make sure that you watch the video that was posted on Monday and you complete the Edpuzzle. And also download the Edpuzzle app on your iPad. Thank you, and have a good day.